Crypto Crashdown. The 5 stocks most exposed to Bitcoin. A deep dive into put option plays. Intro segment. Setting the stage. Welcome back to Markets Under Review, the show where Wall Street meets blockchain and insight is always in the money. I'm your host name, and today's episode is all about big risk, bigger volatility, and the stocks that fall hardest when crypto tumbles. We know that Bitcoin is the linchpin of the digital asset world, and with its sharp swings, a single BTC move can send shockwaves through equity markets. But what happens when the music stops? Which stocks get hit hardest? And, crucially, why are these the prime candidates when you're looking for put option plays? In this episode, we'll unravel the stories behind the 5 equities most exposed to a crypto downturn. MicroStrategy, MSTR, Coinbase Coin, Marathon Digital, Mara, Riot Platforms, Riot, and Hut 8 Mining, HUD. We'll break down how their business models are tethered to cryptocurrency's fate, explore historic stock reactions to Bitcoin slumps, and close with a scenario ladder, mapping out price levels and potential stock fallout to guide your strike selection strategy. So grab your charts, power up your notepads, and get ready, because when crypto sneezes, these companies catch pneumonia. Music sting, quick fade. Segment 1. The context. How and why crypto stocks crash. Let's set the scene. The past year has served up stark reminders that crypto stocks don't just trade in tandem with Bitcoin. They often act as leverage on steroids. In October 2025, Bitcoin crashed more than 14% in a single session, triggering over $19 billion in leverage liquidations and exposing deep structural frailties throughout the crypto-linked equities. During that crunch, every stock with substantial Bitcoin exposure, from miners to exchanges to holders, amplified the digital pain in their price action. But why do these names, these 5 in particular, fall hardest when BTC tanks? There are 3 primary reasons. Direct BTC holdings. Some firms, most notably MicroStrategy, have transformed their balance sheets into Bitcoin vaults. Their equity performance is now inextricably tied to BTC's price, core revenue reliance. Others, like Coinbase, rely on trading volumes and transaction revenues that surge with BTC's volatility and dry up in a panic. Infrastructure and mining exposure. The miners, Marathon, Riot, and Hut 8, live and die by Bitcoin. When BTC falls, their business model teeters, as revenue plunges and operational costs become suffocating. In short, in a crypto crash, business models built for the boom become liabilities in the bust. Segment 2. Deep dive, stock-by-stock breakdown. Short musical segue. Let's break down each name, dissecting their specific exposures, vulnerabilities, and why the market targets them for downside trades when Bitcoin wobbles. 2.1 MicroStrategy, MSTR Corporate Treasury or BTC proxy play. If you follow the Bitcoin narrative, MicroStrategy is more than a footnote. It's the headline. Under Michael Saylor's leadership, MicroStrategy flipped the switch from a business analytics company to the largest publicly traded corporate holder of Bitcoin on the planet. As of late September 2025, MicroStrategy holds over 640,000 BTC, around 3% of the entire Bitcoin supply. That's an astounding conversion, and the numbers are jaw-dropping. $47.35 billion total BTC investment, averaged by price near $73,983 per BTC, financed mostly through debt and repeated equity dilution, over 260% shareholder dilution since 2020. In essence, MSTR has become a de facto Bitcoin ETF, but with leverage, business overhead, and debt on top. So what happens when Bitcoin falls? Stock moves exponentially. Historically, MSTR's correlation with Bitcoin is near perfect, 0.85 or higher. When Bitcoin dips 10%, MicroStrategy's shares routinely tumble 15 to 25% or more. Balance sheet stress. With heavy debt and perpetual new stock offerings, every BTC drawdown lifts the odds of a liquidity crunch, debt covenant breach, or forced Bitcoin partial liquidation. Premium compression. In good times, MSTR trades at a premium to its net asset value, NAV. In stress, that premium vanishes, amplifying the drop. Recent turbulence saw MSTR plunge to 6-month lows amid buyers in stress on Bitcoin, with market chatter swirling about possible S&P 500 exclusion and growing operational risk. In a sustained BTC crash, MSTR magnifies every move, making it a textbook target for put option strategies. 2.2 Coinbase. Coin surging volumes or sudden silence. Coinbase, the first major crypto exchange to list publicly, has ridden the crypto wave to stratospheric heights and harrowing depths. But the exchange's business is deeply sensitive to market sentiment. Core fragility. Coinbase extracts most of its revenue from transaction fees and trading take rate. When prices soar and volatility surges, retail and institutional traders pile in. However, the moment panic sets in and BTC begins to slide, volume collapses, and so do profits, structural risks. The launch of Bitcoin ETFs and the rise of decentralized exchanges, DEXs, have chewed into Coinbase's once dominant market share. The company's take rate, aggregate trading fee as percent of volume, has dropped from 2.5% to barely 1.4% over the past year, and spot trading revenues are down more than 35% quarter over quarter in some stretches. New risks post 2025. Regulatory clampdowns and data breaches, notably the $307 million hack disclosed in 2025, have further eroded confidence and created looming legal and operational overhangs. When Bitcoin crashed in October 2025, Coinbase stock dropped sharply, nearly 15% in a single day, with transaction volumes and user engagement in free fall. For traders seeking puts, Coinstock is an obvious lever against the continued crypto meltdown. Fall in BTC triggers lower engagement, less revenue, and a shrinking earnings base. 2.3 Marathon Digital, Mara mining at the edge. Marathon Digital is all in on Bitcoin mining. Its model is elegant in boom times: scale up hash power, accumulate BTC, and ride the cycle. By September 2025, Marathon was the second largest public corporate holder of Bitcoin, with more than 52,000 BTC on its books and a staggering 60 plus EH/s in operational hash rate. But the risk? Extreme sensitivity. When the price of Bitcoin falls, Marathon is doubly hit. BTC reserves are marked down in value, and new coin rewards are worth far less. It's like running a mint until the currency you mint plummets in value. High operating leverage. Marathon finances growth with convertible notes and periodic BTC sales, meaning its cash flow can turn sharply negative as price and mining economics deteriorate. Profitability tightrope. In 2025, Marathon was praised for its wind-powered expansion in Texas and new forays into AI/data centers. But these remain small next to its Bitcoin exposure. When the BTC price drops toward break-even mining costs, especially post-halving, Marathon scrapes the red. The October 2025 crash saw Mara stock essentially collapse, flanked by high volatility. During a true crypto winter, Marathon is among the first to get wrecked, making a popular put option choice for hedging BTC downside or speculating on worsening market conditions. 2.4 Riot Platforms. Riot miner with a power play, but still exposed. Host. Measured clear. Riot Platforms, a giant of Texan Bitcoin mining, mirrors Marathon in many ways. Massive hash power, scale, and a heavy focus on operational efficiency. Riot boasts over 19,000 BTC in reserves as of August 2025 and has expanded aggressively through power credits, data center buildouts, and even nascent ventures into AI computing. But what makes Riot different? Does it insulate them? Operational headwinds, negative operating cash flow, and huge capital needs remain stubborn risks. Riot posted a negative $77 million operating cash flow in Q1 2025 despite robust gross margins, driven by huge energy needs and upfront miner costs, regulatory and chip supply risk. As noted in annual reports, chip shortages and environmental regulatory moves threaten future profitability. Hash rate expansion is now a race, and every BTC price drop testifies to the razor-thin margins. Leverage to downturns. Riot's all-in power costs are among the lowest, but every crypto crash quickly wipes this advantage. Stock price drops can outpace Bitcoin on the way down, especially as mining difficulty ratchets up and revenue per hash weakens. In October 2025, Riot stock fell more than 12%, as energy hedges and diversification efforts were no match for systemic BTC price freefall.